Hi everyone, it's Jack back with another video. Today we're doing a stock analysis on HP Inc., formerly part of the Hewlett-Packard company. They split up into a couple of different companies, spun off Agilent Technologies at the end of the 90s. So complicated business history. The company is now HP Inc., and that's basically the personal computing segment and some of the printing division from the old Hewlett-Packard company. Not a company that I've previously researched a whole lot of. Came to my attention because Warren Buffett has took up a 10% stake in the company. Thought I was very interesting because previously I thought this was just an old world declining revenue company, but that isn't exactly the case. Holds approximately a 20% market share in personal computers. That's second only to Lenovo, ahead of Dell, who have about 17%, and far ahead of Apple, Acer, who are all below 10%. So it has a decent market position, free cash flow positive, revenue is at least going in the right direction, and it returns a lot of cash to shareholders, so this is a very interesting position. Looking at these valuation metrics, it has all the hallmarks of a classic Buffett investment, a real value play. Looking at the PE ratio, 6 on a trailing basis, 7.68 on a forward basis, very, very low, much far below the S&P 500 average. Of course, this company is not growing like wildfire, so you'd expect it to be reasonably low, but this is definitely not a garbage company by any means, so that is very low in my opinion, very strong for its industry. Price to earnings growth ratio of 0.33, that is tremendously low, thoroughly bargain territory on this basis. I would consider anything under 1 to be bargain territory. 0.33 is like positively dirt cheap. Price free cash flow of 7, this is a very free cash flow generative business, and price free cash flow of 7 is very, very cheap. Not actually even that strong for HP's business. Free cash flow in the most recent quarter was a little disappointing, but even still, this is a very strong valuation, and based off these valuation metrics, this is a very, very good time to buy HP. In the most recent quarter, HP recorded $16.5 billion of revenue, roughly split 70% for personal systems, so notebooks, desktop, workstations, 30% to printing. Interesting, printing, which I would definitely consider an old world, slow growth, not very profitable business, mostly hardware, it was 55% of the total operating profit for the quarter, 19.3% operating margin, which is very strong. Personal systems was just 6.9% operating margin, so that was a nice surprise for me. In terms of revenue by region, they're very well diversified. 41% to the Americas, with 33% of that being to the US. That's up 1% year over year. In Europe and the Middle East and Africa, up 4% year over year, 37% of the revenue is there. And Asian Pacific, 9% year over year growth. All really strong. Non-US net revenue, 67% of revenue. Really impressive, nice diversification. Revenue growth has been a bit all over the place for this company. You can see the most recent quarter, they had about 5% in constant currency. That's down a bit from the previous year, where you can see Q2 2021, 27% in constant currency, which is just incredible. 8%, 9%, 7%, that's the type of numbers they've been pulling in recently, which is pretty good for a company of this size and maturity. Much better than where they were 2 years or so. You can see Q2 2020, they were down at 10% in constant currency, which is really not very impressive at all, but it's pandemic issues and things like that, so I'm not going to ding them too much, but they're in a nice place right now, growing revenue consistently, even if it is coming down a bit from last year against some very hard comparisons. One of my favourite things about this company is its cash flow and how it returns that cash flow to shareholders. In full year 2021, they recorded $4.167 billion in free cash flow. So far this year, they've recorded $1.755 billion, which is slightly off the pace, but they're expecting by the end of the year $4.5 billion in free cash flow, which would be a decent increase over the previous year, around 10%. And a lot of this comes back to shareholders. They repurchase shares at a very large rate, and they increasingly pay a strong dividend. $1 billion of share repurchases in the most recent quarter. You've got to remember this is only a $36 billion business, so that's like 2 or 3%. In 2021, they bought back $6 billion of shares. So you can see they are really, really chewing down the share count and paying a healthy dividend going forward. 0.25 per quarter per share. It's 5.96% forward dividend yield. Very, very strong. One of the biggest negatives about this company is its balance sheet. It's not overly impressive. They have a cash set ratio of 0.44, which, while not terrible for the industry, is pretty weak for HP's history and just not very good overall. I would much rather that be 1 or above and them to be in a net cash position. Interest coverage of 21.33 indicates that they have a very long time to pay this debt. They could pay, with this year's EBITDA, they could pay 21 years of interest, so I'm not worried about this at all. It's one of the more healthy positions this company's ever been in. A debt to EBITDA of 1.2, again, reasonably healthy position, not ideal by any means, okay for the industry, but very good for HP's historical comparisons, showing that management really are pushing this company in the right direction. It's been given an Altman score of 2.49, which indicates a grey area if it is possible that this company could come under financial distress in the near future because it's less than stellar balance sheet. I do not believe this will be the case, purely because this doesn't fully account for its free cash flow, which is excellent, of $4.5 billion. I can't see this going anywhere. Traditionally, personal computing and things like that have done very well in times of recession, and I believe that HP will weather the recession and high interest rate environment absolutely fine. From a margin point of view and a profitability standpoint, there's some very nice metrics here. 20% gross margin. You've got to remember this is predominantly a hardware company, so while that isn't overly impressive, it is decent for the industry and strong for HP's historical comparisons. Operating margin of 8.6%. As I mentioned, this is primarily driven by the printing segment, which is 30% of the company. Good for the industry. This is a manufacturing hardware business, so that's a decent score for the industry, and very good for HP's personal comparisons, for a net margin of 9.61%. Again, a very good number for HP's company history. Return on assets percentage of just shy of 17% is very, very strong. Right above, well, it's more, I would expect between 5 and 15% for a company of this size and maturity, so 17% is above my expectations. Very, very strong for the industry. And again, this company, it just continues to excel on its own historical comparisons. Again, with return on invested capital, just shy of 18%. Very, very strong for a company that trades at 7 times earnings and 7 times free cash flow. It's been profitable 9 out of the past 10 years. And from all of these metrics, balance sheet aside, which I'm not that concerned about, I think this is a thoroughly investable balance sheet with its free cash flow. I think this is a very, very attractive margin profile. Of course, one of the most important things in any value investor's toolkit is the discount cash flow calculation to work out a fair value based on intrinsic valuation of the company and the sum of its future cash flows. For this, I've gone super conservative. Over the last 10 years, the free cash flow of this company has decreased 2.4% on a compound annual growth rate. However, over the last 5 years, it's up 20% over this average growth rate over this time, and 13% in the last year. I believe that this trend is going to continue, but much, much lower. Single digits at a push, 3 to 5%, that type of range. I don't think this is sustainable growth. This is also coupled with revenue. Revenue's up 12% in the last 5 years. It's maintained its market share and increasing incrementally. But again, I don't think this is fully sustainable. I think they'll go up slightly. Again, 3 to 5%, maybe a bit higher, but not more than 10 in my opinion. But for this calculation, I've used 0% growth rate of free cash flow in the growth stage and 0% in the terminal phase, just to be purely as conservative as possible. For essentially, if this company just maintains exactly where it is, not growing revenue as it has been doing, this coupled with a 9% discount rate for the long-term returns of the stock market gave a fair valuation of $42.94 compared to a current stock price of $33, indicating a nice upside here if this company purely maintains. Actually, if it decreases free cash flow around 3% a year, it would still be above fair value, which I think is a really nice position to be in. So the true value of this company is that it's trading far below its intrinsic valuation. I think, again, this is a company that is using its free cash flow, in addition to this, that its natural growth rate is using its free cash flow to buy back shares at a really strong rate. So I think this could provide decent returns over the longer term. I absolutely came in sceptical to this analysis of HP. I thought it'd be an old world company with very poor revenue growth, if any, but I was more expecting a decline, very little free cash flow to talk about, buying back shares and paying a grossly high dividend, but I was very much mistaken. Turns out, who knew? Warren Buffett knows what he's talking about and is a good investor. I know, shock. I really like this company. I think it's buying back shares at an incredible rate to where it's really going to bring that share count down. See, in 2021, which admittedly was a year of high free cash flow, it capitalised on that greatly by buying back $6 billion of shares. Now the market cap is $36 billion. That'd be an incredibly high percentage to come down, reducing the share count massively. This is exactly what a company like this with low revenue growth should be doing, paying a consistent dividend, rewarding shareholders for holding on by returning value to them in the form of cash as dividends and share buybacks. I actually think there's decent value to be had here, and it's definitely a company that I'm going to be adding to my portfolio in a 1 or 2% things, because I think this is exactly the type of company that I'd be happy holding in a recession. It's dirt cheap on all fundamental valuation metrics I can find. My discounted cash flow calculation with a about as conservative as you get, just absolutely maintaining its free cash flow as it's going forward. Gave a fair valuation, $10 above the current stock price, so at least 30% upside from here. I'll be really happy holding this in my portfolio. Again, I'm not going to have a huge position. I think 2 or 3% of my portfolio, but I'll be quite happy with. It's not a company that I believe is going to knock the doors off with its growth. I don't think it's going to change the world in any way by any means. It's not a hyper growth company, but I think it can provide a decent rate of return at S&P 500 levels or above if it continues to buy back shares, pay a nice dividend, and grow its revenue incrementally 2 to 5%. I'd be really happy with this investment if it played out like that, which I believe it can. Of course, tell me what you think. Tell me you think Buffett's wrong. Tell me you think I'm wrong. Tell me what you think in the comments below. Like and subscribe if you enjoy the content. I'll see you again next time.